Today we're discussing Chapter 1 of Limitless by Ch1, which focuses on how the Federal Reserve responded to the 2008 financial crisis and how that moment reshaped its role in the economy. Before this crisis, the Fed mostly operated in the background, using interest rates as its primary tool to influence economic activity. Most people didn't really think about it or fully understand how much power it had. However, as the crisis unfolded, the Fed was forced to step far beyond its traditional responsibilities and take on a much more active and visible role. What makes this chapter especially important is that it shows a turning point. The Fed wasn't just adjusting the economy anymore. It was actively trying to prevent a complete financial collapse. Similarly highlights how policymakers were dealing with uncertainty and fear, and how they had to make a decision quickly and often without knowing exactly what the outcome would be. This created a situation where the Fed became not just a regulator, but a crisis manager. They shift matters because it changed expectations. After 2008, people began to look at the Fed as an institution that could step in and stabilize the economy during extreme situations. That's a huge responsibility, and it raises important questions about power, accountability, and risk. So as we go through this chapter, we're really looking at how one crisis pushed the Federal Reserve into a new era, one where its actions would have lasting effects on the economy and on public trust. To understand the Fed's response, we first need to understand what caused the 2008 financial crisis. The crisis began in the housing market, where banks and lenders were giving out mortgages to people who often didn't have the ability to repay them. They were known as subprime mortgages, and they were risky from the start. At the same time, housing prices were rising, which made lenders feel more confident because they believed homes' values would continue to increase. However, when housing prices began to fall, everything started to unravel. Borrowers defaulted on their loans, and the value mortgage-backed securities dropped significantly. Financial institutions that had heavily invested in these assets began to lose money quickly. This created a domino effect across the financial system, leading to major bank failures, frozen credit markets, and widespread panic among investors and consumers. Under normal circumstances, the Federal Reserve would respond by lowering interest rates to encourage borrowing and spending. Lower interest rates make it cheaper for businesses to invest and for consumers to take out loans, which can help stimulate economic growth, but during the crisis, interest rates were already very close to zero, which meant the Fed had to run out of its most commonly used tool. This forced policymakers to confront a major challenge. How do you support the economy when your usual methods no longer work? According to Ch1, this is where the Fed began to experiment with new strategies. These decisions were not easy because they involved stepping into areas that were not fully tested and could have unpredictable consequences. However, the urgency of the situation pushed the Fed to act quickly in order to prevent the crisis from becoming even worse.
What's really interesting about this chapter is how it shows the level of uncertainty that surrounded the Federal Reserve's decisions. This wasn't just a situation where policymakers had one singular clear path or plan or a set of instructions to follow. Instead, they were responding in real time to rapidly changing crises and conditions. Markets were crashing, financial institutions were failing, and confidence within the economy was disappearing. In that kind of environment, doing nothing and staying still is not an option. At the same time, the actions the Federal Reserve were taking were not guaranteed to work. In fact, there was a real risk that some of these policies could make things worse or create new problems down the line. That's what makes this moment so significant. It shows how economic policy can involve a lot of trial and error, especially during extreme situations. Another important takeaway is how the Federal Reserve's role expanded beyond what traditionally people expect from them. Instead of just influencing the economy indirectly, it began to take direct action to stabilize financial institutions and markets. This shift blurred the line between monetary policy and more active forms of intervention. For many people, this raised concern about whether the Federal Reserve was becoming too powerful or taking on responsibilities that should belong to other parts of the government. Some of the other key policies that the Federal Reserve introduced during this time were quantitative easing, or QE. QE involves the Fed creating money and then using it to purchase financial assets, such as government bonds or mortgage-backed securities. In doing this, the Fed increases the amount of money circulating within the economy, which helps to lower long-term interest rates and encourages borrowing and investment. The goal of QE was to provide liquidity to financial markets and help restore confidence within the economy. When markets are unstable, business and consumers often become hesitant to spend or invest. By stepping in and purchasing assets, the Federal Reserve aimed to signal that it was committed to supporting the economy and preventing further collapse. In addition to QE, the Federal Reserve also expanded its lending programs. It began offering loans to a wider range of financial institutions, including some that would not normally have access to its support. This was another major shift because it meant that the Fed was directly intervening in the financial system to keep key institutions afloat. These policies, although highly unconventional, played a critical role in stabilizing the economy. According to Smilek, the Fed's willingness to innovate during this time helped prevent a much deeper and long-lasting recession. However, these actions also set a precedent, showing that the Fed was willing to use aggressive tools in times of crises.
The long-term significance of these actions cannot be overstated. The 2008 financial crisis changed how the Federal Reserve approaches economic downturns and reshaped public expectations about what it can and should do. Before this crisis, the Fed's role was relatively limited and predictable. Afterward, it became clear that the institution had the ability to take much more dramatic action when necessary. This shift has had lasting effects on economic policy. For example, during later crises such as the COVID-19 pandemic, the Fed quickly implemented similar strategies, including large-scale asset purchases and expanding lending programs. This suggests that the lessons learned during 2008 continue to influence how policymakers respond to economic challenges today. At the same time, this expanded role raises important questions. If the Fed has the power to intervene so strongly in the economy, how should that power be regulated, and how do we ensure that its actions benefits the broader public, rather than just specific sectors of the economy? These are the kinds of questions that Smilek encourages readers to think about as they consider the Fed's evolving role. Of course, the Fed's actions during the crisis were not universally supported. One of the main criticisms was that its policies seemed to benefit large financial institutions more than ordinary people. While the Fed was working to stabilize the overall economy, many individuals were still facing job losses, foreclosures, and financial hardships. This created a perception that the system was unfair or that certain groups were being prioritized over others. Another concern was the potential long-term impact of these policies. Some critics worried that creating large amounts of money and keeping interest rates low for an extended period could lead to inflation or encourage excessive risk-taking in the future. These concerns highlight the trade-offs involved in crisis management. While aggressive action can help in the short term, it may also create challenges later on. Overall, Chapter 1 of Limitless shows how the Federal Reserve transformed during one of the most severe economic crises in modern history. By adopting new and unconventional tools, it was able to stabilize the financial system and prevent a deeper collapse. However, these actions also sparked important debates about power, fairness, and the role of government institutions in managing the economy. In the end, this chapter leaves us with a key question. How far should the Federal Reserve go in trying to protect the economy during times of crisis? Thank you all for listening